people that hold bonds or cash, savers and bondholders, they end up kind of getting screwed over, because even though they might get paid back nominally, their purchasing power that they get paid back with is less than the amount they put in. So that's kind of a risk for that group. It tends to benefit debtors. So people that have a lot of debt, they might deleverage a little bit, but then they get eased because their debt, the purchasing power of their debt, decreases, and there's so much more money in the system that over time, kind of nominal GDP, nominal incomes can go up faster. Although, and a lot of it's based on the fact that the unit that they're measuring the currency with is devalued. So they kind of have more currency units, but the same amount of debt. So the debt to income ratio or the debt to GDP ratio can be decreased, even though the actual nominal amount of debt didn't go down by that much. Now that has different effects, because it's always a really challenging event, right? Because if it's done poorly, it can be hyperinflationary. It can be just currency gets wiped out, total reset. Other times it can be done partially. So for example, back during the Great Depression, World War II era, a lot of developed countries devalued their currency, and they managed to avoid hyperinflations, but their currencies lost anywhere between a third to 2/3 of their purchasing power pretty rapidly. So it was a significant devaluation, but not a complete devaluation. It tends to benefit people that have hard assets, people that, real estate, precious metals, even equities to some extent if they're reasonably priced, things like that have a scarcity that still hold their value. And it really comes down to how much productivity there is in the system. So if they manage to maintain productivity, then after a period of currency devaluation, some people get screwed over, some people benefit from it, and then you can still build anew from that productive base. However, if it causes societal issues, and a society kind of rips itself apart, then the country can face much longer issues because the inherent productivity is kind of set back. All that fiscal spending, they essentially monetize it. So they kind of expand the monetary base to buy a lot of those treasuries. So they have the power to kind of assist fiscal, but they can't just spend themselves. So they are kind of setting the stage and saying, hey, it's all the fiscal, is not much we can do. We hit the zero bound. And that's kind of the same situation we saw back in the 1930s. And, we'll see how that plays out. If there's not a lot of fiscal, it's possible that monetary authorities could take rates negative. Now, we've seen that play out in Japan and Europe, and it's really not good for the banking system. This whole kind of modern banking system is not designed for negative interest rates. Their whole premise is that they're based on profiting from the spread between long-term interest rates and short-term interest rates. So they kind of need a positive yield curve in order to profit. And then when you get kind of unprofitable banks, you have less bank lending, right? Because if they're not profitable, it's harder for them to lend, and it just kind of results in kind of a contraction in that industry. So Jerome Powell cited multiple times that there's not really evidence that negative interest rates are effective. Now, it's possible they'll go there anyway, but at the current time, that's not their stated plan. So if you look long term, if you look over the past, say, 2 centuries, whenever a country gets well over 100% debt to GDP in terms of sovereign debt, so whether it's USA or Japan or countries in Europe, generally there's some sort of default that happens over the next, call it 10 or 15 years. And so far, Japan's the one that's been able to push it longer than anyone else. And it's not necessarily a nominal default, because usually countries don't default in their own currency. It happens very rarely on a sovereign level. Usually what happens is they experience some sort of inflation, and then they pay back the debt in inflated dollars. So for example, in World War II is the only other time we had debt as a percentage of GDP, federal debt, that was anywhere comparable to what it is now. And the way that they paid that off was they had pretty strong growth after that, but more importantly, the Federal Reserve capped interest rates. So they wouldn't let Treasury yields go above 2.5%, even though inflation in the 1940s was very high.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now let's continue.
So inflation in the 1940s was very high, and the result from that was that treasuries were essentially inflated away partially. They lost about a third of their purchasing power in that decade alone. And so that kind of process tends to devalue currency, it tends to devalue debt, which has all sorts of consequences for some people, either good or bad, depending on which side of that you are. If you're the government, you benefit from your treasuries not even keeping up with inflation. If you're a holder of the treasury, you don't want that to happen. So that's over, call it 10 years, I think treasuries are unlikely to keep up with inflation. And I think that, we're going to have kind of a lot of kind of large deficits for a while. And it's going to be kind of a pretty challenging time for politics to kind of settle and determine a direction it wants to go in. One of the kind of the dark ways to look at this period is that we've, in some sense, been in a depression for about 12 years now. And what I mean by that is if you look back at the Great Depression, so you had the 1929 bubble, then you had the big fallout from there. And it, we had like 3 years of just brutal. The GDP went down, stock market went down, and it kind of bottomed in 1933. That's when they started doing that whole gold depegging and all that. Then you started to get kind of a rebound from there. So you had the stock market go up, you had kind of unemployment kind of find its bottom and start to improve, and you had an improvement all the way up through about 1937. And then in 1937 they had another recession. It wasn't as big as the previous one, but it was kind of they had another recession before they ever had a real boom. So they kind of, then they, 37, 38, 39, it was just kind of a really kind of stagnant environment with slow growth. And then of course you had the war start in the early 40s, and that kind of changed everything. And you started to kind of just throw money at it and reindustrialize everything, and it was really kind of challenging time. So if you fast forward after 2008, so we had that, we had that big fallout, and then we had a rebound, so we had that recovery. However, this has been one of the, even though it's been a very long recovery, it's been a very slow growth recovery. There's not been a lot of, it's not been a lot of like fast GDP growth. We barely got above 3% inflation-adjusted GDP growth in the best years during the past kind of decade-long expansion. And if you look at labor participation rates, so unemployment rates only kind of measure people that are actively looking for jobs and can't get them. So there's kind of different ways to measure it. There's people that can't get any job, and then there's people that are kind of underemployed, or they want, say, full-time work, but they can only get part-time work, for example. Okay. That's kind of another measure of it. It's called like the U6 rate. It's another unemployment measure. Then there's people that are underemployed. So like they got a history degree, but they're working like at Chipotle or something, and they want to have a job that kind of uses more of their skills, but they're kind of a job that doesn't require what they've specialized in. So you have that underemployment problem. And then if you look at another measure is just labor participation. So you take the adult population, and you can even say like between the ages of 18 and 65, for example. And you kind of look at that and you say, okay, what percentage of those people are working? And that never got back to its peak level. So we've had kind of a smaller share of the population working. Now, some people would guess logically that's because we have older societies, so we have fewer people working, but it's actually somewhat been the opposite. So older people, in some ways, are more likely to work than they used to, which you touched on, because many people can't afford to retire. On the other hand, we actually have younger people under 25. Especially men. The current environment's kind of displaced a lot of jobs that were more traditionally male, like manufacturing.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members, where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active, and see you on the other side.